It's a great honor for me and a real pleasure to welcome the speakers as well as all the attendees at this workshop on legal pandemic, non-performing loans, and the role of Europe, which is actually meant to foster a debate on what is in the first place an economic issue from a legal perspective, highlighting some of the very different legal dimensions involved by this issue. Meaning with that, on the one hand, the private law level, the level of the law of obligations and the contract law, where we appreciate the individual dimension of the creditor-debtor relationships. But on the other hand, the public and regulatory legal framework, where we appreciate the collective dimension and meaning of debt. I should say that this event is addressed to a very wide audience, which entails students, scholars, and experts from very different backgrounds and areas of interest. And I say that because this explains from my side why I will now give a brief introduction of the topic before I give the floor to the first speaker. And this explains why also my introduction may sound quite familiar to the experts of this topic. I will try my best to keep it short for them, and I apologize for that. So thank you, Sabine, for putting the first of the 3 slides of my presentation. I will focus on 2 main points, which are also 2 questions. First of all, what does legal pandemic mean? Why speculating about a legal pandemic in the first place? What do we mean with this expression? And secondly, why non-performing loans, also known as NPLs, which is apparently a very narrow and technical topic, as the starting point of a discussion about legal pandemic. So please, Sabine, if we can go to the next slide. We're ready. So the answer to the first question, what do we mean with legal pandemic and why discussing about it today, comes down to 2 basic features of our economy. First, it is a global economy, and secondly, it's a financialized economy. It is structurally based on debt-creditor relationships. Debt and over-indebtedness is nowadays no longer a concern of business and commercial actors. On the very contrary, access to credit is becoming increasingly relevant in consumer activities and in the lives of individuals, to a certain extent becoming an alternative to the welfare state measures. And this brings about the issue of consumer insolvency besides commercial insolvencies. States themselves rely on access to credit to achieve their political goals and fund policies. So we can say that nowadays, debt-credit relationship dominates the whole spectrum of socioeconomic relationships. And against this background of a global and financialized economy, defaults and insolvencies are by definition capable of triggering domino effects, of triggering a contagion effect to the from the so-called real economy to the financial system and backward, not to mention the final step of the sovereign debt crisis. So the metaphor of the contagion of pandemic applied to economy and to the legal framework is not something new. We all experienced that during the global financial crisis triggered in 2008. But the one we're living today seems to be quite a different story. In fact, the global financial crisis of 2008 was originated mostly, even though not only, but mostly inside the financial system and then spread to the real economy, whereas the present one is it's seeming to go in the opposite direction. We have and we experience a combined shock in demand and offer in the real economy due to the prolonged lockdowns measures, whereas the financial system has been expressly called upon to fight this crisis back. And I do want to stress very much the role of banks in the landscape of the public response to the coronavirus pandemic, because it's paramount to understand the meaning of this workshop. Banks, as I said, have been called upon by the European regulators and the national legislators among the European member states to actively support the public response to the pandemic, granting continuity in the access to credit. And this goal has been achieved through a set of measures that all do involve or have a great impact on the banking system. Deferral of payments, the so-called moratoria, state guarantees for new credit, suspension of enforcement proceedings, both the bankruptcy proceedings and the individual enforcement proceedings, some extent of flexibility in the capital and requirements and provisioning of banks. We are going to go into the details of some of these measures later on in this workshop, but what I want to stress here as a matter of introduction is that all of these measures do share one very effect. They all have this very specific effect in common of temporarily preventing the debtor from going insolvent or to going to default vis-a-vis the banking system. And I stress this because it's precisely here that we find the issue of non-performing loans comes to the fore. And I move to the second part of my introduction, and to the next slide, please, Sabine. So why the choice of non-performing loans as the starting point of our discussion? It may be useful here to remind, to myself at least, what NPLs are, and then we will pass to why they are so important today. When talking about NPLs, we mean bank loans that have certain characteristics. First of all, banks that are more than 90 days overdue, or loans that, even though not past due yet, are unlikely to be repaid unless the bank commences enforcement against the debtor on collateral or on debtor's assets. Also, bad loans are non-performing loans, so loans against the debtor which has been declared bankrupt or insolvent. NPLs made their massive appearance at the aftermath of the global financial crisis in 2008, growing till their peak in 2018, when they very strongly hit, I would say, the agenda of the European institutions. And the attention of the European Union regulators and legislators was justified by the detrimental effect the high volumes of NPLs do have on the bank's profitability, liquidity, financial performance in general, as well as on the price of bank's equity when the bank is on the market. We unfortunately don't have time here to go into the details of this very interesting and to some extent controversial dynamic, but in a nutshell, what's important here to say is that the higher the amount of NPLs in the bank accounts, the less the capital available on the market, and the more fragile the overall banking system. And I say that because it's here that we find the intersection between the issue of NPLs on the one hand and the risk of a legal pandemic in the current crisis, where banks, as I just said, are a central pillar of the recovery policies of European member states. So they must be able to keep on lending, but they must also be sound enough to be capable of absorbing losses. This said, we have to add one other point. We don't see now a very high number of NPLs in the bank's account. Why? The so-called NPLs legacy, which means the amount of NPLs that originated in the global financial crisis, had been substantially decreased before the outbreak of the pandemic, thanks to that action plan, also about that action plan launched by the European institution in 2015. But what we're facing now is a new wave of NPLs that are currently and by definition underwater, not evident in the bank loan books yet, because, and for the very reason that they will surface only when those measures that I just mentioned, moratoria, suspension of bankruptcy, and so on, which prevent the debtor from going defaulted or insolvent, will expire. Only at that time, we would face the risk of the so-called cliff effect, so a massive reclassification of borrowers to defaults and the subsequent risk of a legal pandemic. Approaching the last point of my introduction, I'll conclude recalling the words of one of the members of the ECB Executive Board, who recently said that, I'm quoting, "In the blink of an eye, the coronavirus pandemic and the response to it have placed the global economy in an induced coma, he says. So in other words, the response to the pandemic, the legal measures in response to the pandemic have put the economy in an artificial and unnatural appearance of viability, which was meant to be utterly temporary, but may turn out to be something more than a temporary crisis of liquidity, at least for some economic sectors. So if all of this is true, it may be the right time now to discuss about how the legal framework may in itself be a driver of non-performing loans. In other words, what's the current legal framework related to this issue and how it may be part of the problem for a legal pandemic. But it's also made the time now to discuss how the legal framework may serve as a part of the solution to the risk of a legal pandemic, and at which layer of the legal framework structural changes should take place, whether at the level of private law, of the individual dimension of debt-creditor relationships, at the level of insolvency framework, at public level, or at regulatory level. It's with all of this in mind that I end my introduction. Thank you very much, Sabine. And I will give the floor now, with a very minor change in our timetable, to Professor Andrea Zoppini. Professor Zoppini is full professor of the Università degli Studi Roma 3, where he holds the chair of civil law. Very welcome, Professor, and please, I hand over to you. I see him.
Oggi sì, ma io la richiesta ovviamente per un comfort di sereno, ma noi in questo punto non abbiamo più niente.
Professor Zoppini, noi la sentiamo.
Quindi ormai gli asset sono in lei.
È un altro
professore. Questo qui credo che non
no,
era
vedo che aspetta.
It's another one.
Which one?
Perché la richiesta
No, I see Professor Zoppini, maybe can we just umschalten the microphone on Professor Zoppini, and I will just write to him that I'm sorry for that. Then I will approach Professor Zoppini, and maybe I should give the word to, sorry, yeah, I would ask Professor Orlandi to now to go with the first speech, because I think Professor Zoppini has some problems with the connection.
Okay.
He should be here. He is here, but I think he has some technical problems with the connection. So yes. Thank you very much. I will present Professor Orlandi, by the way.
Thank you.
Very welcome. I very warmly welcome you, Professor, and thank you for having accepted my invitation. So Professor Mauro Orlandi is full professor of civil law at Università Cattolica del Sacro Cuore in Milan, and he will today talk about rebus sic stantibus. Thank you very much.
Thank you very much to Valeria Confortini, and good evening to everybody. Today I will discuss if and how the pandemic affects the obligation and the debtor-creditor relationship at the Italian law. Among the legislative measures in response to the pandemic, I will focus on one provision of the Italian legislature. I pray now, Sabine, slide number 2, yes. I will focus on one provision, that is the Article 91 of the Law Decree number 18 of 17 March 2020, whereby, and I read now the provision, compliance with the containment measures set out in this decree, what we would call the lockdown measures, shall always be assessed for the purpose of excluding the debtor's liability pursuant to and for the purposes of Article 12:18 and 12:23 of our code. Well, this provision offers the starting point for a discussion on exception and emergency with respect to the strength of contractual obligation. But it also sheds light on the interplay between the so-called contractual liability set out in Article 12:18 of Civil Code and the patrimonial liability set out in the Article 2740. Now let's start with the first point. Please, slide number 3. Okay. In the structure of the Roman obligatio, the famous Romanist Emilio Betti engages a memorable polemic with Silvio Perozzi. Betti defines the obligation as a redeemable captivity serving as a guarantee of a free person to another. While Perozzi argued against the possibility of extending the concept of vinculum beyond the persons to the things, Betti maintains the idea of a profound deep similarity between the condition of a person held in captivity and the thing held in pledge. Thus, Betti assigns primogeniture to the obligatio ex contractu versus obligatio ex delicto, which offers the idea of staying pres stari, being a hostage of the creditor, a radical constraint, we could see, which puts in stake nothing less than the personal freedom of the sponsor. The word sponsor is not an accident. I would say contains the deep meaning of the word responsibility. Respondeo derives from spondeo, which indicates the solemn act of promising and guaranteeing. The word responsibility implies the idea of being a guarantor of a course of future events. The responsus pronounces the words that commit him to guarantee a future relationship's stability. Time and future are essential, in my opinion, to the statement and the meaning of responsibility. In the light of this sort of sacrality of the sponsio and of the language of the oath, we understand that honoring an agreement is a matter of consistency between the action and the word given. With the formula et ego tibi respondeo, the sponsor guarantees the certainty of the future. The meaning of rispondere is therefore linked from the outset to human action and their consistency with the word, the commitment, and the promise. Well, in this situation, the pandemic exception does challenge two of the main elements of the obligatio, the Bettian and Roman obligatio. On the one hand, the guarantee commitment of the promise, which implies a totalizing force involving all the freedom, personal and patrimonial, of the sponsor. On the other hand, the linguistic essence of promising, which has the sacred character of taking the floor and swearing. If I had more time, I would recall the idea of Giorgio Agamben who in the solemnity of the jurandum sees the very origin of the juridical. But I will try to stick to the schedule and I will overlook it and go to the next point. So, please, okay. Allora, this small review of the history of the concept of obligatio sheds light on the distance between tort and non-performance, and thus between the two classical forms of liability, contractor liability and tort liability. The contractor obligation makes the future foreseeable and the promise certain. The creditor will have what is due, either directly by cooperation of the debtor or indirectly by enforcement on the assets pursuant to Article 2714, whereby the debtor guarantees the performance with all his present and future assets. The title that I here use as a synonym of obligation determines a certain value which is promised and secured. It identifies the creditor, that is the person to whom the performance is addressed. And so it establishes what I would call vincolo patrimoniale. We could translate it more or less with a patrimonial bond. That means an economic value determinable at the time of the constitution of the obligation, on the one hand, and the corresponding stand of the assets pledged in guarantee pursuant to Article 2740 of our code, on the other hand. In other words, the vincolo patrimoniale seems to secure a certain economic value which is expected by the creditor, the so-called expectation interest, and guaranteed by all the present and future assets of the debtor. So let's focus a bit more on the meaning of this guarantee. The patrimonial guarantee recalls the concept of prestare, the Bettianan concept, to be as a prey hostage in the hands of creditor, who is entitled to take possession of debtor assets against the will of debtor should the latter fail to voluntarily perform its obligation. The title of the obligation provides for a certainty which lacks at all in the vacuum of the tort, I think. It implies at a logical before the legal level the economic value of the performance and of the non-performance. Unlike the tort, the extent of damage and liability is logically given as determined or determinable when the contractual obligation arises. In the light of what I just said, the so-called contractual liability or liability for non-performance turns out to be essentially a patrimonial liability, a process of appropriation of the value deducted in obligatio. I should further detail this statement, but for time limit reasons, I will assume that patrimonial liability is an essential part of the structure of the obligation, understood as normative structure of if-then, of the hypothetical judgment if-then. If this is true, then we should extend the legal regime of the contractual limitations of liability also to the patrimonial liability. I'm thinking about an issue that may sound more familiar to the Italian attendees than to the general public, I know, but that I consider important to understand the pandemic exception. I'm referring to Article 1229 of our code, which states that any preventive limitation of the debtor's liability for gross negligence or fraud is void. On this point, I do agree with the opinion of our Valeria Confortini, according to whom the parties cannot limit or exclude the debtor's patrimonial liability beyond the extent of minor negligence. If this was not the case, that is, if we should restrict the invalidity to the limitation of the personal liability, the credit would turn out to be a merely pure nominal value. In other words, we should then accept the idea that willful or grossly negligent non-performance can remain without any compensation. And I will be happy to discuss it further, since I know that the majority of the Italian literature doesn't agree with this interpretation of Article 1229 of our code. But the imperative nature of liability seems to imply the legal necessity of compensation. In other words, the necessity that the creditor obtains satisfaction by foreclosing the debtor's assets. Article 1229 seems to express a further and different systematic sense, a further and different sense. To make Article 1218 of Italian Civil Code, which provides for the objective impossibility of performance, non-imperative. I would say that this article, by limiting liability to a measure of fault, the parties with this article end up disposing of the case of non-performance. They may render relevant the degree of fault. Through the exemption clause, the debtor will not be required to prove the absolute or even objective impossibility of performing. The debtor may more simply limit itself to proving the absence of gross negligence, and so the conformity of its conduct with the degree of diligence required in the concrete circumstances. The obligation thus appears compatible with the category of non-performance by minor negligence. It will be a weak obligation, so to speak, exposed to the justification of the degree of fault, distinguishable from the strong obligation whose liability resists until proof of objective impossibility. And we now come to the slide number 5, if I'm not wrong. In the certainty of the obligatio brings in the pandemic emergency. And that brings me back to the provision that I mentioned at the beginning of my speech, that is Article 91. As I said, this provision offers the starting point for a discussion of exception and emergency with respect to the strength of the obligation. Here, I would like to focus in particular on the concept of impossibility of performance with respect to the need to assess the restraint measures. The compliance with the restrictive measures may imply a lack of liability. The main question is could the creditor nolente debitore satisfy his right through debt collection and seizure of assets? Or does the pandemic situation, or whatever one wishes to call the respect of the containment measures, in itself paralyze any enforcement action? This question raises two issues related to the so-called contractual or non-performance liability. Firstly, whether the patrimonial liability can be limited, just like the so-called personal liability. Secondly, whether liability may be excluded, not because of impossibility, but because of the mere unenforceability, inesigibilità, of the performance, where the debtor could not be required to make an effort that goes beyond ordinary diligence and good faith. The unpredictable breaks in the captivity logic of the Bettian obligatio, the first measure which changes things, we could say. The linguistic constraint of the promise, rooted in sacred language of oath, is challenged by the force of the fact that the parties have not predicted and not planned. The main question is, to what extent does the law of promise resist the exception, the hermeneutic and conclusive force on things? And so we have the slide number 5. Unpredictability. The answer of this question comes down to two normative concepts, and I would like to emphasize their normativity. The foreseeability of the damage outlined in Article 1225, serving as the limit of so-called contractual compensation, and on the other hand, the normal risk of the contract. Among others, on Article 1467. The feature of the contractual obligation is, we would say, represented, made present, and foreseeable at the time the obligation arises. Far from being a merely subjective criterion, foreseeability is the measure of the patrimonial commitment, and it's a legal justification, what we would call causa, hence the very foundation of any liability. In other words, the damage foreseeability as a condition for compensation does not lay on the practical level, but rather on the one of the causa obligandi, that is, the interest assumed in the relationship and shared by the parties. It is not a question of subjective evaluation to be carried out ex post. In the debtor's shows, can do, predicting from his point of view the personal knowledge of the other party's interest. One should not look at it from a naively empirical perspective, falling into the trap of evaluating the individual's private science. Instead, one must consider the debtor's obligation, which consists of committing a specific portion of assets corresponding to the shared utilitas in the structure of obligation. In this slide, the creditor's interest in the performance recalls the vinculum's origin, when the debtor promises, foresees, and therefore guarantees the performance in its economic value. Just like the determinability of the object required by Article 1346, it is an essential requirement which belongs to the structure of the obligation and serves the purpose of determining the extent of the patrimonial liability. In this way, it's possible to establish that one could define causal value, valore causale, of the obligation, deducted in vinculo and guaranteed by the debtor. On the same line stands the other concept implied by the promises Bettianian logic, the normality of the risk, or that recalling the human ignorance of the future is anyway subject to measurement. To measure the risk, men use the standard of normality, once again summoning the universal category or causality by which men are able, or perhaps have the illusion to be able to dominate the future. This said, the contractual promise faces a twofold concept of risk. The normal risk, typical of every cause of representation of the future, and the abnormal risk, which exceeds the limit of foreseeability. Therefore, the title is aleatory when it burdens the debtor of the absolute, unknowable, and unpredictable risk. The ancient scholastic class of non-aleatory contracts is based on the normality of the risk, where normal means foreseeable. The risk lies in the structure of the contractual obligation and determines their extent. Accordingly, when applying the pandemic law, the judge seems to be called upon to establish the normal boundaries of the binding foreseeability. The unpredictable seems to cross the line of the promise, a line within which the title is binding and beyond which it has no effect. The principle rebus sixtantibus implies the restriction of the vinculum and of the debtor's liability within the limit of the concretely enforceable conduct. So, the final slide, let me sum up some ideas. The contractual obligation brings about, by definition, the patrimonial liability of debtor, a certain economic value which is due to the creditor and which he can obtain either by voluntary performance or through enforcement, false execution. To be responsible seems to correspond to this very condition of being subject to forced execution, of losing of one's asset through the use of legitimate violence. I would say that the meaning of responsibility does not lie in the judicial sentence of a civil condemnation, but in its execution. Following Betty, the binding nature of the obligation affects the debtors, originally even personal, in our time, patrimonial freedom. If it fails to perform, is subject to enforcement necessarily. At the same time, enforcement is not independent of the cause of non-performance. The pandemic rule seems to introduce the hermeneutic of fault, under which the circumstances will be assessed according to a circumstantial criterion of diligence. In this light, and when drawn into the normative structure of the obligation, that is the statute of the obligation, if non-performance, then patrimonial liability, the entire dynamic of liability would seem to be affected by the hermeneutics of the pandemic exception. The judge seems to be called to assess the demandable effort in the performance rebus sic stantibus. Beyond this extent, the debtor will not be responsible, since his promise is ultra vires, we can say, and exceeds the limits of forcibility and normality. Emergency overcomes the objective impossibility of normal times, making the difficulty of performance unpredictable and unbearable. I will conclude with the sort of provocative statement that the pandemic exception sheds light on the supplementary nature of Article 12.18, what we would call natura suppletiva dell'articolo 1218. That is the hermeneutics of fault, which seems compatible with the dispositive and one might even speculate supplementary character of Article 12.18 of our code, and which appears to be non-imperative nor. Hence, the parties may substitute the objective impossibility with the fault criterion, excluding the relevance of non-performance due to minor fault. Therefore, if the parties may validly agree on a liability restrictions for a minor fault, a fortiori, the same effect may follow from a rule on the state of exception. Beyond the extent of the fault, assessed according to the hermeneutics of the circumstances, there is no more enforceability, that is, no more liability. Thank you for your attention.
Thank you very much, Professor Orlandi. As I said, we're gathering the questions in the chat box, and I will be happy to receive from the audience their questions for you. Also, after your speech, we are gathering them. We already have some for you, but I will stick to the timetable. And now I'm delighted to welcome here Professor Christoph Paulus, who in his very long career at the Humboldt Universität zu Berlin have taught, among others, Roman law, civil procedure law, and insolvency law. So he will talk about today Corona, NPLs, and fragile states. Welcome, Professor, and please, I leave you the floor.
Thank you very much, Valeria. Thank you very much. Thank you also for inviting me to this really, really important issue. And I am putting emphasis on this important issue because your introduction with our exposure to what is coming of what we have to expect with the loans and with the extension of money to the economy. I will expand this a little bit, and that brings me to the first slide. I begin first with presenting a couple of facts, and then I will clarify what I mean with an even higher risk than that what you have said. I've taken out just by happenstance. I was looking around and I found, by looking around this here, for instance, very recent BIS, Bank of International Settlement statement, where you have the COVID pandemic triggered the largest economic downturn since the Great Depression. That is clear. Although the macroeconomic outlook is currently more favorable than it was at the peak of the crisis in the spring of 2020, the second wave of the pandemic is placing an additional strain. We can add now, speaking here in Berlin, that the third one will also hit very harshly the economy, additional strain on the recovery and reinforcing existing vulnerabilities, at least in some of the major advanced economies. Non-financial corporate bankruptcy rates remain fairly low in most countries, despite the sharp decline in economic activity. However, they are expected to rise as measures to support credit are wound back. New consumption habits and business practices accelerate the downsizing of specific sectors, and some firms run out of liquidity. The looming increase, that is now the important sentence, the looming increase in corporate bankruptcies will generate credit losses that will need to be absorbed either by the financial system or by taxpayers. That is important. Brings me to this next slide, please. There I have, again, just randomly chosen this graph, which tells me not much, but I see a growing mountain, so to speak. And I see on the bottom that non-bank deposits, and I see on the below the headline amounts outstanding. So these three things, which I do pretend to understand, they are looking pretty alarming, because the denominator are trillions of US dollars. Listen, we are talking about trillions. I, being an old guy, I remember that we in Germany, when we had the reunification, that people became nervous, and it was even written in the newspapers that the politicians start to talk about hundreds of millions. And that was unheard of, because before measures or help was measured in millions, but not in three figures of millions. And now we are talking here about trillions. I mean, that is really something which is impressive. Of course, it's worldwide, but nevertheless, I mean, it shows the dimension where we globally are heading it. The next slide, please. This is very recent, I think from last week. Again, I picked it up, and since we are here in an Italy center, at the Italian center, I thought it would be appropriate to quote this here. Italy may ask state-owned asset manager AMCO to handle a mounting pile of government-backed sour loans issued to support businesses during the pandemic. The government guaranteed almost 115 billion euros of bank loans to small and medium-sized companies through a fund managed by Medio Credito Centrale SBA, a state development bank which is indirectly owned by the finance ministry. When an emergency suspension of loan repayment starts being lifted in the next several months, banks are likely to lean on state guarantees and transfer the risk of the fund. This brings me now to the next slide and to what I call a triple jump. Let me begin with the following. Forgive me, that is sort of stupidity, but I can't resist the temptation to mention this. A couple of years ago, I've written an article on that we should concentrate in insolvency law, not just on the normal, what I call the good weather insolvency law, where circumstances and the markets are functioning, but we should also concentrate and have an eye on what I call the bad weather insolvency law. Bad weather insolvency law was used by me because we had in those days a couple of rainfalls and there was a flooding in certain regions of Germany. And all of a sudden, very quickly, the legislator reacted and changed some insolvency rules in order to prevent a disaster stemming from the applicability of the insolvency law. So that is what we have now. We have now the need, what Stefan Madaus, who's listening here and whom I agreed full-heartedly, what he calls pandemic law. We need something like pandemic law, particularly when we are now turning into an era of pandemics, plural, as some of the virologists are saying. Now, what do I mean with triple jump? A crisis like the present one is threatening the real economy. I mean, we all, and when I look at my dear friend Nacho, I'm pretty sure that he, like me, wish only few things more than meeting again in a restaurant, sitting together, having a wonderful dinner and a great wine, drinking together with a couple of friends. Now, this isn't possible, and that is a wonderful example for how the real economy is threatened. We have, as we have seen on the first slide, however, in this statement from the Bank for International Settlement, we have not yet the insolvency wave in the real economy. One of the reasons is that the states, plural again, is helping out. They're giving grants, but also loans. And that is what Valeria, what you have referred to already. Loans are wonderful help for today, but tomorrow they need to be paid back. So we are talking about the deferral of repayment. And the time of repayment is painful because then you have to earn double income. You have to pay the ongoing costs and you have to pay the repayment of the previous loan. This brings us, and that is jump number 2, to the increase of NPLs. I mean, that is exactly what you have read in these previous slides, which I brought, which I showed before. That is threatening the banks. And I mean, Italy knows what that means, the increase of NPLs and the correlation with banks. And now comes the third step in the Valeria. That is what you have omitted and what I think to be the most dangerous. And that is, there is an equation for centuries. That is, you could call it experience. That there is an equation between bank insolvency and state insolvency. When banks are going bankrupt, they're usually helped by the states. And the more banks are fragile or are exposed, the higher the risk for the state because it has to pay more and more. I mean, until when I started to deal with questions of sovereign insolvency, that was 20 years ago, it was hard to find examples. And usually I took then the example of Germany, which went bankrupt twice in the last century, but there were historical examples. Unfortunately, all those who are present in this room, and whom I see that they are participating here, have by now sufficient experience by themselves from today that this correlation between state and bank insolvency is a very actual and topical problem. Look at Iceland. It began in the recent time with Iceland. You had Ireland, you had Cyprus, you had Greece, you had, I mean, it's also Italy, it's Spain, it's Portugal. And you could also add Germany and France, because the payment to Greece, to a certain degree and to a high degree, was preventing the insolvency of a bank, of their banks including the Deutsche Bank and the Paribas and so on and so forth. So therefore, you have this additional problem. And that is what makes the present crisis extremely dangerous. It's not so much as of today. I just learned a couple of hours ago that Germany is again pouring, I think, 73 billion euro into the economy in order to save them. That is good for today. But the tomorrow, that's the big problem. And that brings me to the last slide. Frau Greiner, bitte. No, one before. Right. So this is, I should add here, it's CP is me, that is Christopoulos. I should add my dear friend Ignacio Tirado as well, because here I tend to recommend highly to you all who are listening, but primarily actually to politicians. And we are trying again to advocate for it. We have a need, here I write, an eminent need for the establishment of a insolvency proceeding. We need a procedure for defaulting sovereigns. Because the situation that we have right now, that's a disaster. It's politically a disaster, it's economically a disaster, it's in many, and it's legally also a disaster. It's in many respects just disastrous. And we need this orderly proceeding because the huge advantage of law, and that is my last word here in this context, the huge advantage of law, of a procedure, of a legal procedure, is that it provides guidance in a chaotic situation. That is the greatest advantage that law can contribute to the disasters which are bound to happen. And once again, that is what we learn from the virologists, we are entering the era of pandemics, and therefore we better start today rather than tomorrow to solve the problems. Thank you very much for your attention.
Thank you, Professor Paulus. Yeah, I hope we'll discuss about it further in the debate, because both of you and Professor Tirado are very much experts of Insolvency, and maybe we will discuss it during the debate. I have some questions myself. I would now welcome Professor Sirena. I would go to the next speaker to stick to our timetable. Professor Sirena is a full professor at the Bocconi University, where, among others, he holds the chairs of private law, European contract law, and comparative private law. He will talk about moratorium on payments and renegotiations of bank loans. Please, Professor, welcome, and the floor is yours.
Thank you for the floor. It is really a pleasure to be here today for many reasons. And one of them is that we are hosted by the Freie Universität of Berlin, with which my own university, namely Bocconi, has a long-time agreement of exchange and academic collaboration. And of course, I find awesome that thanks to the Italian Centrum and to the commitment of Professor Hus, whom I would like to thank wholeheartedly, the Freie Universität offers several courses on Italian law, which are currently taught by Dr. Valeria Confortini. Therefore, I'm all the more grateful to you, dear Valeria, and to the other organizers of this seminar for having invited me. As indicated in the program, I'm going to deal with moratoria on payments and renegotiation of loans. I chose this topic because my understanding of banking law is strongly based on the intersection, on the interplay between the vertical approach of market regulation and supervision on one side, and the horizontal approach of rights and duties between the contracting parties on the other side, along lines similar to those that have been depicted by Valeria in her insightful introduction to this seminar. In a modern view, I think the traditional divide between the public law of, say, market regulation and banking supervision on one side, and on the other side, the private law of contracts and obligations. So this divide must be decidedly mitigated, if not abandoned at all. And this divide between the, let's say, vertical dimension of supervision and the horizontal dimension of contracts and obligations must be replaced by a combined approach where standards of prudential supervision flow or may flow into enforceable rights and duties between the contracting parties, and the other way around, the transparency of banking contracts and banks' correctness towards their clients may amount to standards of supervision by the competent authority. If we turn now to the subject of this seminar, it may be said that non-performing loans is a concept belonging to the realm of prudential supervision, whereas moratoria on payments and renegotiation of contracts dwell on key issues of private law, which either fall under the scope of national civil codes or are provided for by pieces of legislation that specifically pertain to consumer protection, as an instance, toward banks. Again, what I find fascinating is this interplay between these two dimensions of banking law, which most effectively may be combined in the framework of alternative dispute resolution systems like ombudsman, particularly when they are organized and they are run under the umbrella of authorities charged with supervision on banks. So inevitably, the outbreak of the COVID-19 pandemic has raised much interest in moratoria on payments and renegotiation of contracts as remedies to address the economic situation of businesses and families that, in the aftermath of the crisis, faced liquidity shortages and difficulties in timely payment of their financial and other commitments. And for this reason, it is not surprising that both moratoria on payments and renegotiation of contracts have been covered by the principles issued by the European Law Institute ELI for the COVID-19 crisis, from which I would like to move from my presentation. Next slide, please, Sabine. Yeah. Here are the principles of the ELI and a kind of table of their content. But I would particularly focus on Article 12 of these principles. Next slide. Article 12 that deals with moratorium on regular payments. So this concept, the concept of moratorium deployed here, is, however, particularly broad and encompasses several types of support measures, which, if applied to bank obligors, have a different impact on the assessment of the credit risk and therefore on the classification of exposures. It is of the essence that different categories of support measures are distinguished for the application of the prudential requirements and the calculation of own funds requirement. And this is the bulk of my intervention with regard to the impact on private law and private law concepts like moratoria on payments and renegotiation of contracts. Of course, moratoria on payments are intended to address short-time liquidity difficulties caused by the limited or suspended operation of businesses and individuals. And moratoria schemes can be either legislative or non-legislative, because some member states of the EU have introduced jurisdiction-wide moratoria based on specific legislation, on specific legislative provisions, Other member states' moratoria have been implemented differently through voluntary, industry-wide, or individual initiatives by institutions. Sometimes, as it happens in Italy, we find a combination of legislative moratoria schemes and non-legislative moratoria schemes which coexist. So in broad terms, a moratorium on payments can be defined as a payment relief for obligors who are thus allowed to suspend or to postpone or even to reduce payments, but only within a specified period of time. And even more importantly, they must return to regular payments after the situation has come back to normal. Therefore, a moratorium on payments inevitably affects the whole schedule of payment in the sense that either it leads to increased payments after the period of the moratorium itself, or it leads to an extended duration of the loan. So Article 12 of the ELI principles clearly opts for an extension of the payment scheduled, and particularly it stipulates that this rescheduled shall not eventually lead to any increase of the calculation of the amount due or of the amount of other installments. This is a relevant point because this provision that is here in the first, it's contained in the first paragraph, runs contrary to a practice that is quite common on the marketplace, a practice according to which the amount not paid during the moratorium, and particularly the amount of the accrued interests during the moratorium, must be recompensated by the borrower, at a later point of time. Article 12 of the ELI principles run contrary, that neither the calculation of the amount due nor that of other taxes or installments subsequently due are in any way increased. So why does Article 12 of the ELI principles stipulate this rule? Because it is this provision or this principle is clearly underpinned by a principle of solidarity, which is also explicitly mentioned in the third and last paragraph. According to a principle of solidarity, the unforeseeable consequences of the COVID-19 crisis should not be at the sole risk of one party, namely the borrower, but should be shared with the other party, namely the lender. So the lender has to sustain a certain loss, and particularly it has to sustain the loss of the amount of the interests accrued during the moratorium. Yet, this provision creates a friction with the guidelines issued by the European Banking Authority. Next slide, please. Guidelines issued by the EBA to ensure that despite payment moratoria, the credit risk is identified and measured in an accurate manner. Of course, this point is seen as crucial in order to provide true information about the quality of banks' portfolio to market participants and to ensure that institutions are adequately capitalized. To these guidelines, the European Banking Authority clearly sets forth that the application of a general payment moratorium due to the COVID-19 crisis should not per se lead to a reclassification of the bank exposures, which should continue to be categorized as performing or non-performing in accordance with the applicable requirements. In order to ensure that the application of a moratorium on payments does not alter the assessment of risk credit, however, this moratorium must meet the requirements. Next slide, please. The requirements that are listed, that are posed by the European Banking Authority in its guidelines, and that you can read in this slide. So back to Article 12 of the ELI principles. If a payment moratorium has as a consequence a loss that must be sustained by the lenders, and particularly the loss of the amount of the interests accrued during the moratorium, which are not owed by the borrowers, as it is recommended by Article 12 of the ELI principles, well, in this case, this moratorium fails to meet the requirement number 5 that is here listed from the guidelines by EBA, because this payment moratorium does not change only the schedule of payments, but it changes also the interest rate. And if that is the case, however, next slide, please. If that is the case, however, a moratorium shall not be considered as a mere moratorium as such, but it amounts to a forbearance measure. On the basis of EU law, forbearance means that credit institutions grant a concession towards a debtor that is experiencing or is likely to experience financial difficulty in repaying a loan or more loans. And since the aim of forbearance measure is that of helping the borrower who is experiencing this temporary difficulties with the repayment obligations, credit institutions should grant these measures only specific to the financial circumstances of the borrower and to the loan agreement. But if that is the case, next slide, please, exposure may have to be classified as forborne, be they performing or non-performing. And the same applies in other cases where credit institutions grant any other form of individual measure, particularly when they renegotiate the loans, taking into account the specific situation of individual obligors. Moreover, next slide, please. Forbearance measures are to be considered as distressed restructuring. I'm here summarizing strongly my intervention because I realize that I do not want to run out of time. So forbearance measures can amount to distressed restructuring, and therefore, next slide, please. The obliger can be even classified as defaulted, provided that these measures led to diminished financial obligations, according to paragraphs from 50 to 52 of the EBA guidelines on the application of the definition of default. So next and last slide. Thank you, Sabine. My conclusion is that scholars of private law, but sometimes even legislators, should be more aware or more mindful of the impact that the different types of moratoria on payments and renegotiation of loans can have on the classification of exposures, because there is this link, because these measures of private law and the assessment of credit risk, which may become negative and therefore detrimental to the obliger that was meant to be supported that way. So this connection should be all the more taken into consideration from the viewpoint of the role played by information services rendered by credit bureau to the market participants. Thank you very much.
Thank you very much, Professor Sirena. Thank you very much. I collected also some questions for you on this very important section. Thank you. I will now please ask Professor Zuppini to take the floor. I already presented him, and so I will now just give him the floor.
So thank you very much. Thank you, Valeria, for inviting me, and I apologize, maybe I was late before in getting the floor. So I'd like to stress only one point, basically, and I heard all what the colleagues said, and I would like just to highlight one issue, which is why did the NPL market reach the peak in 2015? The peak in Europe was something like 341 billion euros in 2015. So I guess there are at least three possible answers, but I'd like to add one more, which refers particularly to the Italian experience. So generally speaking, banks' lending policies were, I would say, ultra expensive before 2008, and banks were much less regulated. Second, the great 2008 recession led to an increase of debtors' default rate, that what we experienced basically from 2010 to 2011. And a third reason was that the NPL transactions were something extraordinary then, and the market was not ready to assimilate the big wave of distressed credits. So that's something we could say all over Europe, but I think when we speak about the Italian experience, we have a special reason, I would call it, which is basically that enforcement procedures in Italy are particularly inefficient and ineffective. Basically, they are very slow. And that's what happened was that the effect of debtors' default rate was very, very slow on banks' balance sheets. So basically, we developed an NPL market somehow later than what happened in other countries. So now we have to ask ourselves, the COVID-19 pandemic has not shown a full impact on economy, but we can ask ourselves what's next, so what we'll experience next. And I guess that, of course, there are a lot of similarities with the 2008 global financial recession. So basically, it's reasonable that the COVID-19 will cause a recession as the global financial crisis in 2008. I think that notwithstanding some similarities, first of all, the Italian banking system it's somehow, thanks to ECB and thanks to European policies, is much more solid and resilient. So Italians banks are much better off than what we experienced in 2008, and that's a first point. And I think that so that's one point. There is another point where we have to stress just to understand how the market of NPL will evolve, is that basically, if I take in consideration Italian market, now we have an increasing number of operators. So basically, there will be much more operators who are apt to absorb the wave of distressed credits. So basically, what we lack still is something like an improvement in enforcement procedures. That still lacks, I mean, in my opinion, in Italian system. And basically, if we want to have an effective and efficient enforcement procedure system, we need to mix together information and time. So we need more information, and we need a reaction which implies a shorter time of reaction. It's not easy, I can understand, but as I always say in this kind of situation, basically we have effective enforcement procedure in Italy, and this is the public enforcement procedure. It's what we used to call Invitalia. Invitalia had effective enforced procedure because it could act with public information and at the same time with very, very fast reaction procedure, freezing procedure. So it's something I think we should develop and work on in Italy, because as we now all understand, the more enforcement procedure are slow, the worse it is for the banking system, and the worse it is for the cost of credit and the efficiency of the legal system altogether. So thank you very much, and that's my comment on what I heard.
Thank you very much, Professor. You actually opened the discussion, raising actually one of the main reasons why the legal framework may in itself be driver of the NPLs. And so thank you for raising actually issues and questions, and we'll continue the discussion with Professor Tirado, who I'm very grateful for having accepted the invitation as well. Professor Tirado is a full professor of commercial law at the Universidad Autónoma de Madrid and currently Secretary General of UNIDROIT. Thank you very much for being here, Professor, and yes, please, I hand over to you.
Grazie Valeria. Buonasera a tutti da Roma. Hello everyone, thanks a lot for staying connected. It is my pleasure, my honor to be here, and for that I am to thank the Italian Centrum at the Freie Universität Berlin and Valeria Confortini especially. It is a pleasure because of the topic, because of the importance of the seminar, and because of the possibility of sharing the talk with good old friends like Professor Paulus, but also with admired colleagues like Professor Serena, Professor Orlandi, and others. So I will be very quick. My presentation is a slightly different. It has a more of an economic content, although at some point it ties in very well both with the presentations of Christoph Paulus and of Professor Serena. I slightly agree with a remark made before that this crisis is actually relatively similar, or has similarities with the previous crisis. I believe this crisis to be quite exceptional. This crisis happens globally at once, simultaneously in pretty much every country in the world, and affects basically all sectors. I do not believe we can recall a situation such as this globally ever, because we have seen even world wars, but world wars didn't really quite capture the entire world, but this does capture the entire world. And in such an economically interrelated situation such as the one we have today, that matters very much. Let me take the reflection to the 2008 crisis, 2010 in Europe, when Greece went into insolvency, for example, and Germany and a number of countries within the European Union wanted to impose an austerity approach. The reason for that was, well, we went through our own crisis a few years before. We worked hard, we tight expenditure, we were austere, and then we were able to come up more efficient, and therefore that's the way to do it. Of course, the Germans were right, but they were only partially right. They were right because by being austere, they became more efficient, but by becoming more efficient, they were able to place their assets at a lower price. And they did that because other countries were then growing. So they became more efficient, but other countries bought their assets and they were able to export and go back. The problem is nowadays that doesn't happen. No one is out there to buy the assets. So austerity would, of course, never be the answer, as the German government, and I'm speaking about Germany because this is a German-Italian seminar, have not advocated for this. So this is just one of the lessons from history, isn't it? Furthermore, even the treatment of the pandemic seems pretty clearly to have shown that even if you adopt a very loose approach to how to treat the pandemic, think of the Swedish example. The Swedes decided not to close, didn't they? And yet the decrease in their GDP is pretty much the same as everyone else's. So how is that possible? Well, because our economies are so interrelated that you can just say, well, I'm smarter than the rest, I'm not going to close. Because if you do that, it's just not going to work. So we are in an exceptional situation, and that exceptional situation has caused a number of exceptional changes, which I think we should be very much aware of. First of all, it has completely transformed the European economic management framework. The economic governance of the European Union has been completely overhauled. Think, for example, first measure, the fiscal policy and the fiscal policy rules, even the golden rules, have been suspended. They no longer apply. The deficits can reach beyond the limit that was imposed, and even the debt to GDP ratio has been substantially lowered. I mean, the requirements. So fiscal policy is now out. Second, a recovery fund with very strong firepower has been created, and the way it's being financed and is going to come to countries is economically a pure mutualization of the debt. Therefore, we have something akin to what would be the Eurobonds that no one wanted ever. This is precisely what we're having now. Third, and even more important, the European Central Bank's quantitative easing policy, issuing billions and billions and billions of euro and placing them in the market. That on its face might vulnerate, might alter a number of the ECB's prerogatives and competences, prohibition of monetary financing and other limits of the monetary union and of the banking union, excuse me, which should restrict the mandate of the European Central Bank in theory to containing inflation, which is most definitely not what it's doing. It's actually working as a proper central bank, which is something that at least some of us welcome very much, because it was the missing point, wasn't it, in the euro, in the banking union and the euro building. So this opens a number of question marks, and I'm here to create questions rather than to solve them, and I apologize for that. First of all, is this suspension of fiscal policy going to be flavor of the month? Is it going to just disappear when things go back to normal, when the frontier is open? I don't think so. I think it's going to last a while because the economic crisis is going to stay put for a while. So we will have to see how long this is here with us. Second, European Stability Mechanism, the MEDE as we call it in some countries. That has been a complete failure, hasn't it? No country has resorted to the European Stability Mechanism for assistance. notwithstanding the fact that the ESM had publicly said that assistance would come with no conditionality, which was the main problem of the ESM before, wasn't it? You received money to bail out, to recover your country's economy or your banking system, but in exchange, you had to be subjected to very strong austerity measures, and you would have to pay a non-concessional interest rate. None of that seemed to be coming with the ESM if the countries had resorted to it, but no country has resorted to it, and that I am aware of. And this is so interesting that even in Italy, where it is pretty much impossible to turn on the TV and watch and not see a program which talks about, it's a talk show which talks about COVID, and even European measures are included in the debate. The ESM versus non-ESM was made a big political statement by some parties in Europe, in Italy. And in the end, the non-recourse to it has been a very interesting solution. Third of all, third point or third question that I have. And by the way, the removal of the fund and going back to the ESM in Europe, is this also something which is going to stick around for a while or not? I would think that we have, in the coming months, perhaps years, a political discussion ongoing between countries such as Spain or Italy, strong countries from the south, which didn't like the approach of the ESM and which might push for the maintenance of a recovery fund type of mechanism, which would equate to the mutualization of the debt and Eurobonds, therefore sharing the risks, since we can now also, to some extent, share fiscal policy. So will that change? I don't think it's an easy one to answer. Another point which I believe is very important, and I'd like to go back to that, is the quantitative easing, the issuance of billions and billions of dollars and euros in the case of the European Union. This is not only the case of Europe, the same happened with the United States. I was looking at numbers, and the monetary mass of US dollars has increased in a year in over 20% of the total mass. This is the largest growth of monetary mass in US dollars since the Second World War. Nothing like that has been seen before. This means there's a massive amount of dollars everywhere to be spent. The amount of liquidity is huge. This is, of course, completely consistent with the economic policy observed in Japan in the previous years, the Abenomics, as it was called, which basically was flooding the market with money, with yens in this case. So we have, this is, I believe, very interesting, we have rivers of money everywhere. And what is the effect of this? First of all, very interestingly, this has taken a very direct effect in sovereign debt pricing. If you look at some of the things that have happened in the world, it's been very interesting. Countries which were not in a position to issue their own bonds based and subject to their own law have been issuing bonds and therefore getting financed at their cheapest rate ever. And I'm talking about some South American countries which never could access the debt markets unless they paid a very high premium. That is no longer the case. Or think, for example, of the huge debt issuance made by Brazil, a country with perhaps arguably the worst COVID rate in the world, which has nevertheless been able to issue debt and get financing cheaper than ever. So money markets are making bond markets not work, which is something, the consequences of which we are still to see in the future. And that takes me to another point, which is, if you enjoy the economics, arguably the most interesting point, which is all of this mass of money has caused no inflation. Christoph Paulus is here. This is a German, half German seminar. And I would like to ask my German colleagues, whatever happened to the German inflation in the 1920s and the 1930s. Why the issuance of money was nothing compared to this? Why is this situation not creating inflation? Are we really moving perhaps towards the application in real life of what's called the modern monetary theory, which was a stigma in economic theorists and is the opposite to austerity, because it basically contends, so long as you can print paper, if the paper that you print is being put to a use fiscally until you reach the capacity of the economy to produce, you will not create inflation, and therefore you can deal with the over indebtedness. So it's not how much you get indebted, it's how you finance that indebtedness that matters. That is exactly what seems to be happening these days. And if this is true, you can say some sort of Keynesianism on steroids. The entire economic policy can change, and that approach can really be taking its final effect on the way the European money markets and the European fiscal policy operates. We will see. But everything seems to be tumbling down. Everything seems to be changing. Everything seems to be changing. Nothing compared to this crisis on this regard. I had a few additional matters to talk about concerning banks, but many of the things have been addressed already and much better by Professor Sirena concerning non-performing loans and the need for regulatory forbearance. I think it's very clear that there is a need for regulatory forbearance precisely because it is this widespread simultaneous interference with contracts that and the impossibility by many to comply with their debts that has created false insolvencies and false non-performing loans. So if you don't create regulatory forbearance, what you're doing is you are actually destroying assets which were in reality much more valuable than you might think. So the forbearance is absolutely necessary. I know I'm using too much time, so I just finalize saying that this crisis can also be used by the banking system, perhaps by countries to help their banking systems, which mostly have an obsolete business model to recover by means of giving them a generous fee in the main task that banks are going to have in the coming months, even years, which is to channel public funds onto the real economy by lending to businesses. If they charge a proper fee, that will help the banking system without attracting too much attention to the markets and therefore putting them on the target for insolvency. And sorry for the extra time, Valeria. Thank you.
Thank you so much, Professor Tirado. We are actually inside the debate.